Welcome back, everyone. As we seek to balance the scales of risk and reward, this discussion, which is coming up, will focus on the strategies that can lead to sustained wealth creation even when the market's exuberance tests our resolve. Now, please welcome our panel ready to guide us through the intricacies of investing in a high valuation landscape with the end goal of sustained wealth creation. We have Mr. Bhavin Shah with us, the founder and portfolio manager at Samiksha Capital. He has been rated the #1 technology sector analyst in institutional investors polls for a decade. He has 20 years of experience building top research franchises, 7 years as managing director and the global head of technology at JP Morgan, 6 years as director and head of Asia Pacific technology at Credit Suisse, and 5 years as founder of Equities Securities. He has pursued a double major in economics and finance, beta gamma sigma cum laude from the University of Chicago Booth. We have with us Mr. Jyoti Vardhan Jaipuria. He's the founder and MD of Valentis Advisors. He has an overall 36 years of experience in the Indian capital market, including 21 years at DSP Merrill Lynch and 8 years at ICICI. Mr. Jaipuria was head of research and strategist for India at DSP Merrill Lynch. He helped build the research team as the leading research provider in India, as well as one of the top institutional brokers in the country. As a strategist and analyst, he was also rated amongst the top in India by leading institutional investors and figures in the top 5 leading vote getters regularly. We have with us Mr. E.A. Sundaram, the executive director and CIO at Bugle Rock Capital Private Limited. He has spent the last 19 plus years in managing long only portfolios with separately managed accounts and family offices, returning a CAGR of 19% plus compared to the Nifty 500's 16%. In his over 33 years of investment experience, he has been able to demonstrate taking significant contrarian positions, underweight technology in 1999, underweight infrastructure, utilities, power in 2007, underweight mid-caps in 2017, no NBFC exposure in 2018, etc. Mr. Sundaram likes to classify his value investing style bias as common sense investing. His thesis is simple. Investment success can be achieved not only by doing the right things, but also by avoiding the wrong things. So exciting lineup, ladies and gentlemen. This session will be moderated by Ms. Ritika Pharma. She's a director, EVP, and part of the core funding team at PMS AIF World. Ms. Pharma is a highly progressive and performance-oriented individual and carries more than a decade of experience in investment advisory and private wealth management. She believes that the best returns are not made by making best purchases, rather by making informed investment decisions. On the educational front, Ms. Pharma is a commerce graduate from Delhi University, holds financial planning and wealth management degree from the Indian Institute of Financial Planning and Wealth Management, as well as many other investment-related certifications as stipulated by regulations from time to time. So exciting lineup, ladies and gentlemen. I'm going to hand over the proceedings now to Ms. Pharma. We can't wait for this session to begin, Ms. Pharma. Please take it away.
Thank you so much, Aishwarya. Thank you so much for that warm welcome and the introduction. Good afternoon, everyone. A very warm welcome to the esteemed panelists and the audience out there. Let's start the session. 2023 was a blockbuster year for the Indian equity markets. Despite all global headwinds, Indian markets scaled new milestones. The broader markets partied even higher, with small caps making roughly 50% above type of returns. The big question now is, where do we go from here? Will 2024 and the year onwards be another lucky year for the investors out there? Let's try and understand and learn more about this from our esteemed panelists today. So starting with you, Jyoti, what do you think? What do you believe? How does year 2024 and the times from here look like? You believe, this year markets will scale up to new heights, or are we expecting a consolidation this year?
Yeah, Ritika. So, looking at very short term, just the next 6 months, 1 year, we already at new highs. So anything, if it goes up 5 points, also it becomes a new high. But my view is that this year will not make the returns which we made last year. So that's a very easy one to do. Second is we'll have more volatility than we had last year. So I think that is also a very easy case. Third is we have to remember that Nifty's done a positive return for 8 years in a row. So that's a record. So, at some point, by law of averages, we probably need a negative year. Our base case is we are expecting Nifty to give like a small positive return for the year with a lot of time correction and some price correction which comes in. A lot of the price correction may be led by more global factors. So overall, it will be a year where people are like, you've hit us many sixes. Now you just want to defend your wicket at this stage so that when the going gets good again, you want to make money. But what I want to tell people is use this year to build up your portfolio again. Buy the dips, invest in a staggered manner because the Indian economy still looks good. The outlook for the Indian market over the next few years is still good. So there's a lot of money to be made in the market.
Sure, sure. Mr. Sundaram, moving on, so while Jyoti has addressed this part very well, do you believe that this year markets will make new high? Because, if I talk about the current times, we are at the peak of the interest rate cycle, and there is an expectation of a rate cut expected in the second half of this year, maybe towards the last quarter of calendar year 2024. So are we expecting markets making new highs from here?
Yeah, first of all, thanks for this opportunity to participate in the session. Let me begin with a caveat. The views I will express are just mine. It's particularly relevant to the style of investing that we do. So let's begin with that caveat.
Sure.
When people talk of the market, usually the talk is about the index, right? Now, my observation is that the market is not a single monolithic entity. There are parts of the market that are expensive. There are parts of the market that aren't expensive, even when the index is at a peak. We have seen this repeatedly. If you see in the introduction, it was mentioned about the 99-2000 technology boom, where only 3 sectors were performing. The so-called new economy sectors, only these were performing. But several so-called old economy stocks, excellent quality companies, were completely beaten down and ignored. Even in the peak of the technology boom, when the market was at its peak, Nestle, for instance, or several engineering companies, several financial sector companies were available at dividend yields of 10% in March 2000. The second instance was in 2007, when another peak we saw in the market, in the index. In this time, real estate was very bullish, infrastructure was very bullish, power sector was very bullish, but FMCG was ignored. Pharma companies were ignored, automobile stocks were ignored. So the limited point I'm making is, the market is not a monolithic single entity. There are opportunities in the market irrespective of where the index is. When we try to predict the fundamentals, predicting the stock market movement is a function of 2 things: predicting the fundamental movement of the various factors, and secondly, predicting how much of all of this is already built into the expectations. Both are important. So even if we predict the fundamentals correctly, if the expectations around those fundamentals are already built into the stock price, you may not make a very good return if you invest at those inflated prices. So I think an investor is better off not just looking at the fundamental factors, but also assessing the extent of expectations already built into the stock price. That I think is very important. So I would second what Jyoti Vardhan said. There are opportunities in every market. Even in this market, there are opportunities. That's the statement I would like to conclude this session, this part of the session with.
Sure. So this kind of, brings another question on the table. If I talk about year 2023, a part of 2022, and then the year 2023, the rally was largely, fueled by a lot of PSU stocks. There were defense, railway stocks that added a lot to that rally. So which sectors do you believe will participate in the growth? Which sectors look really interesting and exciting, to you at this point in time, which you feel that, yes, will 100% participate in the times to come?
Is this question addressed to me?
Yes, to begin with, yes, Mr. Sundaram.
Okay. See, as I said in the previous question, assessment of the fundamental factors. I agree that infrastructure investment looks very good for the next few years because the demand is there. Capital goods looks very good. Defense looks very good. All these things look very good because of the thrust on infrastructure, on the thrust on physical infrastructure building, and on manufacturing sector in India. Defense also looks very good from a demand point of view. But let's come to the second derivative. How much of all of this is already built into the price? Several of these stocks have risen 3 times, 4 times in the last 1 year. So would I be excited about entering these sectors or these stocks right now? Probably not as much as I was a year ago.
Right.
Because the prices have already substantially run up. So my point is, look at the stocks which have not participated to that extent in the stock market. Within that, let's choose strong quality balance sheets, strong quality comparative advantage companies, and then build a portfolio. If the intention is not to maximize the returns at all points of time, the intention is to first survive in the market and then build over a period of time. So if the intention is always to have the maximum returns at all points of time, you can do that only by diluting the quality of what goes in the portfolio. When the market goes berserk, you can try to beat everybody else only by diluting the quality of the portfolio or taking risks that are not necessary to be taken. There are times when the best thing to do is to not do anything at all. So if something is overvalued in our opinion, just stay away from that sector and look at something else. I do believe that there are opportunities even in this market that we find interesting enough. They may not be exciting as you describe it, but they are ignored and they are neglected, and that's what makes it better.
Sure. What about you, Jyoti? Which sectors you are presently looking at Valentis?
Yeah, so partly I agree with Sundaram that a lot of these sectors, which last 2-3 years they've done well. Like our theme was buy global, buy local, avoid global. The other theme was that within local, focus on the investment themes. Both of these have done very well and the stocks have performed. So now these are both not as easy themes to play as they were at the beginning of the year. One sector which we've been focusing on over the last 6-8 months has been the pharmaceutical sector. And of course, it's a varied sector, but one change which is happening is that the US generic pricing pressure, which we saw for the last 7-8 years, that is easing off. We are probably starting to see a plateau there. So a lot of companies which were struggling because the US prices falling will now start seeing at least better earnings which will come out. So that's one sector which had got beaten down, though other stocks in the pharma did well. The companies which were geared to US generics did not do well, and that is where a big turnaround will come. We've taken some positions there and done well with it. The other sector which we think now is starting to get a bit interesting is banking, because there's a lot of negative news there. NIMs are coming down. We understand all that. So for me, it is over the next few months, probably, we'll get some of these stocks at very attractive valuations. We love to buy when things are in pain, and we generally don't buy with crowded spaces, actually.
Sure. So I have a follow-up question on it, but I'll come back to you, later part of the session. Bhavin, coming to you, first question, your portfolio, Samiksha Capital largely looks at, buying, it's a flexi cap strategy wherein the focus is more on the mid and small cap. So if I talk about the current valuations in the mid and small cap space, they definitely look, little stretched at the moment. So how are you, at the fund, how are you kind of addressing this part? And what do you think investors who are wanting to invest in your strategy at this point in time, they want to put in some fresh money, should be doing, so I want you to kind of help us understand more on this.
Right. So, Kritika, our strategy, remains as we have done before, which is, we invest based on absolute value opportunities in the market. And yes, there are, fewer opportunities today, but we do still find some. And so when we find those, then we obviously try to invest in those across all the portfolios, whether it's existing or new portfolios. And then, among the stocks that we already have in the portfolio, because of what you said about the valuation of the small mid cap, I think some stocks obviously have, got stressed, and we have been reducing our positions there. So that cash that comes through, is available to buy some of these new opportunities we are finding. Other thing we are doing, given where the market is, and I think, so while there is no immediate sort of bad news that one knows of, and one generally doesn't know in advance. Whenever that happens, the market will obviously correct sharply because of the way it has run up. So that obviously will impact the stocks that have been stretched a fair bit. And so what we do is that when we are investing in any new name, we are doing it more gradually. We try to build our target position size in multiple steps rather than doing it in one go. And so I think that's sort of, and I think, to be honest, what has changed about the Indian equities, in my view, in last few years, is that the sector choices have broadened.
Right.
The kind of if you just study the IPOs that have come out in last 1 or 2 years, very different type of companies, in completely new, the sectors that didn't exist before. And so, for example, in the fintech space, and so we have found some opportunities there as well. And I think, and then that's what we'll continue to do. And I think we just be aware of the fact that, value, across the board valuations, overall are obviously rich. And as a result, the risk of sharp correction obviously is higher. But in any case, our framework, prevents us from buying anything that doesn't fit the valuation framework that we have.
Sure.
So that's what we continue to do.
And also, are you looking at some new sectors as well, which you feel that look very interesting at this point in time?
Yeah, I mean, I think I mentioned fintech, for example. Definitely, the whole technology space. The way India is adopting technology. I think it is creating some new opportunities for sure. And we are studying every company in that space. To see where the opportunities are. And I think yes, we have found a few as well. Even the whole sort of shift to digital media, for example, has created new growth opportunities for companies which were earlier, not growing, but suddenly this digital, the shift to digital media has created them the new growth, avenues. So we are looking at that as well.
Sure, sure. What about you, Jyoti? You kind of manage a pure mid and small cap strategy. So how are you managing your portfolio at this point in time? And what do you have to, say to the investors who are looking to enter into your strategy at this point in time? So what kind of thesis are you following?
Yeah, so Ritika, obviously the small caps and the mid caps I have run up much more than the large caps have. If you look at valuations today, they are much more expensive. So, in general, without getting too much into detail, typically the small caps have traded at around 15% P discount to the large caps, and now they are trading at more or less parity. So, for all investors who are getting it at this stage, we're seeing three things. One is that, come into it thinking of this is like a 5-year investment. Second is there's a possibility that you underperform and you do badly at some point whenever the market's correct. We could see a sell-off. Third is we are going to invest in a very slow and measured way rather than invest all the money in one shot. So we will be staggering our investment. And if, like we tell people that if you want to do STP, please, this is a good time to do STP. You at least, start doing STP. So when we get corrections, you are there in it. The only other thing which we are telling people is like if we step back from this year and think of the next few years, as long as the economy continues to do well, the earnings growth in the small cap is going to be much, much higher than the large cap. So to that extent, even when you buy something at probably higher valuation than what you are, you'll probably make returns which are lower than your earnings growth. But if your earnings growth are much higher than the large cap, over a 3-year, 4-year, you will find that even from these valuations, you ended up making returns which are higher than what you did in a large cap portfolio.
Sure, sure. Interesting, interesting. And moving on, my next question is for Mr. Sundaram. If I talk about the current scenarios of high valuation, what steps as a fund manager you are taking to ensure a continued growth, in your investors' portfolio, and you kind of create a continued wealth for your investors? So what steps are you taking? Are you kind of moving a part of your portfolio towards cash, or you are largely looking at adding some large caps, because that's one area that looks exciting, in terms of valuations. So I would like to learn more from you on this.
We run a multi-cap portfolio. So the portfolio is a mix of large, mid, and small at all points of time. So
Right.
that's the mandate of the portfolio. So we do still have a few small cap stocks and a few mid cap stocks. But as you rightly said, the proportion of large cap names has increased in the last few months. That's certainly true. I'm not sure if I try to always give maximum growth to my investors. That is not my intention. The intention is to give them a set of strong companies that are not exorbitantly expensive. So even if, I don't look for, actually speaking, I don't look for opportunities that look very exciting. I look for the risk-reward ratio that are very much in our favor. And they may not come with exciting prospects. Usually these good opportunities come when there is a pall of apprehension or a pall of doubt that is hanging over that particular company. See, let's understand this. We want to buy good quality companies, but we want to buy them at decent prices. That is when we think we'll make money. A good company is available at a decent price only when there are doubts or fears or apprehensions about that company's immediate future. When you and I can see the profits booming, so can the rest of the world. So when the rest of the world is excited about a stock, it is not cheap anymore. So when you buy when the stock is not very cheap, you don't make that much money. So that's our approach to investing. So we want to buy a good quality business when it is viewed with a little bit of trepidation by the rest of the market. And there are opportunities even in today's market of that kind. There are doubts expressed about strong companies, about their ability to compete, about their competitive edge being dimmed, and so on and so forth. Our job, I think our job as a portfolio manager is to come to a conclusion whether the problems the company is facing is temporary or terminal. If it is a terminal problem, obviously we will not like to buy it. But if in our judgment, if in our research we come to the conclusion that the problem is temporary and there's really nothing wrong with the company's ability to compete over the long term, a short-term problem gives us a good entry price. That's the way we have always managed the portfolio, and that's the way we continue to manage the portfolio. So to answer your question, yes, even in today's market, there are opportunities like this available. But as Mr. Bhavin Shah has said, the number of opportunities has reduced, but they still exist.
Sure. So you just mentioned that, you are moving you've recently moved a part of your portfolio, a part of your portfolio towards large caps. So
proportion has increased. The
portion has increased. So are we right in assuming that this is now a turnaround time for a lot of large caps out there? I mean, like we saw a major rally in mid and small caps, we will be seeing a lot of large caps.
This argument, this discussion, I've heard in several forums, both in large investment forums and also in evening conversations all over the country about the stock market, whether large cap is better or small cap is better or mid cap is better. Let's put that to rest, Let's look at data. The index is a barometer of these things. We look at the BSE small cap index, BSE mid cap index, and the BSE sensitive index, which are representatives of the small cap space, mid cap space, and large cap space. Now, Sensex data we have from 1979, but the small cap data we have only from 2003 onwards. So let's take from 2003 till 2024 February. For a period of 5 years from 2003 to 2008, small and mid caps outperformed the Sensex. Then 2008 to 13, large caps outperformed the mid and small cap. Then again from 2013 to 18, small and mid caps outperformed the Sensex. Then again in the next 5 years, large caps outperformed the small cap. Now, I'm just taking periods of 5 years because that's a reasonable time period.
I agree. Yeah.
In the last 1.5 years, small caps has vastly outperformed the large caps. Now, I am not a person who can exactly predict when that tide will turn in terms of which sector will begin to do better. So what we try to do is look at the rolling 5-year returns of these indexes, starting from April 2003 to April 2008, then May 2003 to May 2008, and so on and so forth. We did that till February 2024, rolling 5-year period. You probably will be surprised to know that the average of the rolling 5-year returns of the BSE Sensex, the BSE mid cap, and BSE small cap are roughly the same.
Okay.
the average rolling returns. So if the investor has the ability to predict when that tide will turn, maybe he or she can make a better return with small and mid caps. But I am acting on the assumption that a majority of investors will not have that ability. I certainly don't have that ability. So I am speaking of myself as an average investor. So looking at average of the 5-year rolling returns, the small cap index, mid cap index, and large cap index have given roughly the same return. So what matters is the quality of the business, the type of people running the company, and the valuation at which we purchase it. Irrespective of whether it is a large cap or a mid cap or small cap, these are the things that we will focus on.
Sure. Interesting. Interesting to know that. Bhavin, what about you? Are you kind of moving a part of your portfolio from mid and small caps? I saw Samiksha Capital maintaining roughly 75% in mid and small cap at one point in time. And now the allocation towards large caps have very minutely started to increase. So is that because of valuations looking a little stretched in the mid and small cap space, and you're finding some interesting opportunities at very attractive valuations in the large caps? What do you have to say about this?
So I think there is a little bit of a conscious decision to make that shift. But I am not trying to make a very strong push towards large cap just because of that reason that the small caps have done phenomenally well. I mean, I think if we still find a good opportunity in small cap, I mean, we are not afraid of buying the stock in that space. And I think so I think the shift is probably because there are more opportunities that we have found in large cap rather than being trying to aggressively move towards that. We have a absolute return criteria for investing, and anything that we invest has to meet our minimum required rate of return. So so I think the shift will happen in the natural course. And I think what might happen more of is, as we trim some of the small cap positions, that maybe our cash levels might increase a little bit more, as opposed to just simply a shift to the large cap. Because if the large cap does not meet our return criteria, then we may not be able to invest. But yes, you're right. There has been a minor shift, not a major shift towards
yeah,
the
I was
large cap.
noticing that. Yeah. Brilliant, brilliant. Also, another question to you, Bhavin. Since you're somebody who is specialized in the IT sector, do you anticipate that with the correction, I mean, with the reduction in the interest rates towards the second part of this year, we may see a major shift, a major bounce coming back in the IT sector? You believe, is that on cards?
I think we have seen a bit of a bounce in IT sector, I think, in last, few weeks already. I think sector still looks, to be honest, more attractive than many other sectors that we have in the market, where the way they are valued. So to that extent, some of the relative sort of value focused investors, may continue to allocate more towards IT if they feel more confident about the outlook from the US and so on. And I think clearly the commentary on the deal pipeline was pretty good last quarter, or the most recent quarterly results. So that is possible, but I wouldn't expect that. I mean, the valuation catch up or a little bit of a catch up has already happened. So maybe more of a moderate improvement can be expected in terms of share prices from here.
Sure, sure. What about you, Jyoti? I remember, in the last discussion, you mentioned that you have started to look at pharma as a sector. And, with the reduction in the interest rates, we will definitely be seeing a lot of FIs coming back to India. And we'll be seeing a lot of deployment happening maybe in the IT, in the pharma space. So is that the reason why you've added pharma? Or what is it that you have in mind,
Yeah, so Ritika, we don't try to think what others will do because we can only control ourselves. In fact, one of the way we invest money is the 3 U's. So we do undervalued stocks, but the other 2 U's are we do stocks which have underperformance, stocks which are underowned. So we like to go into space which is not crowded at any point of time. So frankly, software and ITs come onto our screens now that, okay, it's done badly, relatively it's become much cheaper. At the same time, we are it's good. It's, we were totally underweight at some point where we are not as underweight, but it still doesn't seem like it's some very compelling buy. So, one thing which longer term, and probably Bhavin is a better equipped to answer that, is this whole AI which is coming up. I don't know whether structurally it means that, growth will become slower for some of these IT companies. And that's something which we're grappling and debating with. The other thing is, the US economy is done well, and it has surprised on that for a long time now. So it is more like whether we start seeing some dip over there in the US economy, which creates probably a better opportunity to buy these stocks where, people get panicky about it. So I like to buy when people are panicking on some sectors rather than buy it when everybody's excited about a sector.
Sure. What about banks? I remember you also mentioned about adding few banks. So obviously in last 1.5 years, we've seen a lot of PSU banks, adding a lot to the overall returns. What about some private sector banks? What's your view? What's your take on it?
So, Ritika, the way I look at it is I don't look at, typically PSU versus private. For us, it's been, banks are there, corporate banks, they're retail banks. The retail banks were very, very highly priced a few years ago. The corporate banks were very cheap. And,
Yeah.
our thesis for the last few years was that the corporate banks have had a lot of cleanup on the balance sheet, which has driven down their earnings. And, that large part of that cleanup was over. So that's why we were heavily geared towards the corporate banks rather than the retail banks. We continue to be relatively more in the corporate bank space. So what we are seeing now in the banks is, we had one big jump in NIMs, and that's a very typical cycle because your loans get repriced immediately. Your
Right.
deposits take a long time to get repriced. So in the initial phase of interest rates, uh, you going up, you see a big surge in NIMs which happen. And slowly, as the deposits get repriced, the NIMs start to come off. And that's the phase we've seen in the last 12 months where the market is now getting concerned of the NIM coming off. But that's really a part of the cycle. So some of these banks, and I would say it's more like the smaller banks in the private sector space now, are starting to get interesting because they were late probably to clean up their books. And now the books are looking decently clean. They are available at very, very attractive opportunities. So quite often, like when we scan the whole universe to where is value, there's some banks which are standing out as value. So for us, it is on the margin, probably like, banks is something which we're adding in our portfolio. Again, it's underperformed for the last, 12 months. People are negative on it. And it's a space where there is some undervalued banks available.
Sure, sure. Moving on, Bhavin, I have a question for you. What do you think? What are the major headwinds and the tailwinds for the Indian markets, for the Indian economy over the next? I mean, what do you anticipate on that? And then how do you think it can impact the markets? It can impact the equity investors out there?
I think the as far as the headwind, I would say that this pressure to do more social welfare. I mean, I think Indian government debt to GDP is certainly on a higher side, and I think that has prevented this government from bringing down the fiscal deficit. I think, and which I think obviously retains some inflationary pressures in the system, even though the core inflation might be coming off. I think we have food inflation. The overall inflation continues to be, I would say, not low enough in my view. If you look at the way China grew, from say that $2,500 per GDP per capita to all the way to 10, 12,000, they did it all without causing inflation and without running while running very low inflation. And I think we have not been able to achieve that. And I think that that leaves us with a risk of flare in inflation, and which reduces RBI's ability to cut interest rates. So that is, I would say, that is one risk that I see as a measure of headwind. Obviously, our geopolitical situation with China continues to be very tricky, and that I think is a kind of a potential risk that market tends to forget about, but I think it is still lurking out there. I also think that the reforms, while there has been a lot of investment in infrastructure, and there have been various reforms that we have seen. I think there is still a lot more to do across, in many aspects of the economy. I think we have created too much protectionism, sort of kind of a, approach, whereby you're putting in a lot of duties and so on. And by the way, that also, adds to the inflation aspect of our economy. So there is still a lot of that work to do. I think fundamentally our demographic story and the investment in infrastructure obviously create very a good sustained economic growth situation, that we are looking forward to. But I think there are still a lot of things to be addressed. Perhaps for us to achieve our full potential, which could be easily 8-9% real GDP growth. We are still growing maybe at 7% or slightly less than that. So that I think is what I see as sort of more of the risk or headwind, as you say. Obviously, the valuations are a bit of a headwind as well. On the tailwind, I think tailwinds are the investment that is happening in productive capacity, in infrastructure as well as into various industries. And I think obviously there is going to be the positive effects of that we're going to see in coming years. And I think that will support the economic growth, and as a result, strong corporate earnings, I think picture. I think the organized sector continues to win. Even some of the recent, changes with respect to the MSMEs, and the faster payment cycle, inducing companies to pay them faster. I think it obviously results in a faster churn, reduced working capital requirements. These are all positive. So I think there are a lot of positives as well, and I think that's why we are, close to being fully invested even at this stage.
Right. No, I think that's true. What about you, Mr. Sundaram? What do you think? Would you like to add anything to what Bhavin just kind of addressed on the headwinds and tailwinds?
Yeah, I think Mr. Bhavin has covered most of the points. There are, I would say that the employment situation in this country, that is one risk that I would be wary of. The rising, if the risk of commodity prices sharply rising and therefore affecting the margins of several Indian corporates, that's another one that we would be wary of. Then there are so many factors which we really can't control. Who predicted COVID will come? In 2019, there was no talk of COVID, but it shook up the world. So these are some factors which are clearly beyond our control. So I would classify risks into two categories: the one which we can do something about, and the one which we can do nothing about. So if we can do nothing about it, there's no point in worrying too much about it, except carefully building a portfolio that will help us reduce the impact of those risks if should they happen. It's like I would give the metaphor of trying to build a house close to the seashore. So the focus of the architect should be not on predicting when the next tsunami will come. The focus of the architect should be building a house that is strong enough that even if a tsunami does come, the house is less affected. So I would say the same thing about building a portfolio. So what is in our control really? As investors, there are only three things that are in our control. What we buy is in our control. So let us stick to good quality balance sheets. Let's stick to competitive companies. Let's stick to companies where the management has treated shareholders fairly, and where they've proven not just the competence, but also the willingness to share the profits with minority shareholders. And finally, the third thing that is in our control is at what price we buy it. So these three things are in our control: what we buy, how much of it we buy, and at what price we buy. These are in our control. So if we focus on these three things, I think the risk control is enhanced to a significant extent. There will always be factors that are beyond our control and we can do nothing about it. So we will be aware of them. We probably will build a portfolio that will withstand these shocks should they happen. But these three factors that I spoke about, I think are very much in our control, and they are in the control of every individual investor. So I would think of it that way.
Sure. Thank you. Thanks. Jyoti, how would you address this question? You have anything different in your mind?
So, Ritika, not necessarily different, but what I'll highlight is over the last few years, the world was a place where everybody was very easy with fiscal deficits going up. Indian
Yeah.
fiscal deficit went up, the world fiscal deficit went up, so everywhere fiscal deficits went up. I think, now we'll face a situation where over the next few years, fiscal deficits will have to come down. So for India, if you think of large part of the growth which we saw post-COVID, we saw it because the government spending on infrastructure and capex as a percentage of GDP is doubled in the last 5 years. And the fiscal deficits itself doubled, so that gave a lot of room. But probably over the next 3 years, the government will have to curtail its fisc. Like if you see what they said in the interim budget, they really want to go back to the fiscal glide path. So
Right.
then, that whole thrust which we saw from government on capex, that will start to slow down. What we need, therefore, is that the private sector steps in now. And private sector capex is shown some fleeting signs of coming in, but it has been quite slow to come in. So if we get a situation where government capex starts to come down and the private sector does not start stepping up their capex, you will find that suddenly the growth is starting to slow down rather than do well. And some of these sectors which drove all the growth, which was all capex related, investment related, that may start coming a bit under pressure. Frankly, what they've done in the last 3 years will carry forward the momentum for the next 12, 18 months at least. But after that, this is some worry which may start coming if private sector capex don't come in.
Sure. Sure. Bhavin, what do you think? Obviously, while everyone is gung-ho about the Indian markets, and we believe that, yes, India is definitely on a very strong trajectory, and the next decade looks very interesting, very exciting. Not only decade, I think even the more years to come look very exciting and interesting for the equity investors, right? But with respect to diversification, I get this question a lot, many times from my own set of investors who are wanting to diversify their portfolios beyond Indian equity. So, which other markets you feel look very attractive at this point in time, that one can look at to be added in their portfolios?
So, Ritika, I did one study back in 1996. So we are going back 28 years. And I did that study with Michael Mauboussin, who's a very widely read author. He was at Credit Suisse at that time as well. And we looked at markets across the world, for quality of companies, measured basically by return on invested capital, and whether the markets valued those things properly. In other words, higher return on capital would be valued higher by the market. And in 1996, India stood out along with the United States.
Oh.
And I think if you look at the equity returns of these two markets in US dollar terms, they've definitely been the best of all the markets over this long period. And even if you look at last 10 or 20 years, that has been the case. So I continue to believe that any investor, should have an exposure to the US equities, because actually the US equities give you exposure not only to the US economy, which is obviously a very large economy, but also to other economies because of the way the US companies dominate the world. And on top of that, there are a lot of non-US companies listed in the US market. So actually, you don't have to, invest in, 5 different markets. I think by investing in US, one gets that exposure, to, basically the entire world. And I think efficient frontier theory of the investment, tells you that as you broaden your sort of the universe, your risk goes down and return goes up to a point. So I think I would definitely, suggest having some exposure to the US equities. Although obviously the US equities are also done very well, and I think especially some of the mega cap stocks have done phenomenally well. And I think so there is one has to be aware of that at this point. But I think still I think gradual taking gradual exposure to US equities would make sense from a longer term perspective.
Sure. What about you, Mr. Sundaram? What do you think? Which other markets look interesting to you at this point in time, apart from the Indian equities, Indian markets?
See, of course, I agree with Mr. Bhavin Shah that as a diversification, other markets such as the US are definitely good diversification. But since I am not fully familiar with the US market, apart from the general reading that I do, it's not, I am not the right person to recommend an investment in the US market.
Sure.
There are other opportunities here itself. When the interest rates being at the close to 8%, why should we ignore fixed income even now? I think it's a very good investment opportunity. 5 years ago, fixed income was sought after by everybody, but now when the interest rates are at this level, and there's talk that over the next 2, 3, or 4 quarters, we may see a beginning of the reduction of interest rate cycle. Looking at fixed income is not a bad option at all. That is my opinion. But I am an equity person, so I will predominantly talk about Indian equities, which is where I am most comfortable.
Got it. And before we kind of conclude this session, I would want all three of you to kind of give a last piece of advice to the investors out there. What do you think, investors who are wanting to pump in new money, want to invest new money, what should they be doing? Starting with you, Jyoti, how would you address this question for our audience out there?
Yeah, so Ritika, one is India will grow, earnings will grow. So, whether you get in at these times when valuations are high, or you get in later, you'll make money from earnings growth. At high valuations, typically you may end up making returns which are slightly lower than what the earnings growth are. And if you manage to get valuation better, you may be in line with earnings growth. So from a very short-term point of view, I would tell people that, okay, stagger your investment out a bit, just because, when people put money, they're very bothered about what happens 3 months later to the money. So just space it out. You'll get some at a higher price, some at a lower price. But, first is you go and invest. So don't, use this as an excuse that, okay, markets are expensive. I'll come back next year. And when somebody tells me it's cheap, I'll invest, because you may not get markets cheap like that easily. And when you get them cheap, you never end up buying them, because there's always a reason why it's cheap and you want it even cheaper after that.
Right. What about you, Mr. Sundaram? What do you have to say to the investors out there? Because a lot of my clients, they are in fact kind of, holding on to their money. They are parking the money in liquid funds and believe that, that there will be a correction and that's when they will invest. So what do you have to say to such investors out there?
I don't believe that apart from a very small minority of people, anybody can time the market to perfection.
Absolutely.
I certainly can't. So that's one. I think the very important point is the determination of the asset allocation in each investor's plan. And this has to be done after careful thought about the cash flow requirements and the family conditions of each individual investor. One size fits all strategy doesn't work. So this has to be done along with a good investment advisor. Determine the asset allocation first, and then stick to it with discipline through thick and thin. I think that is very important. How much you wish to allocate to equity, how much you wish to allocate to fixed income and other asset classes. Let's determine that depending upon the requirement of each individual family. After that, within equity, how much you're comfortable with large cap, how much you're comfortable with mid and small cap, that also should be determined, because it's a function of how much volatility a person can withstand, without losing his or her sleep. So that's also important to determine. After this is determined, the best thing to do is to stick to that discipline over a period of time, at least through a full cycle. It's very, very important not to, lose heart or get scared when the market sharply falls. Once you decide on this, you have to continue with it with discipline. The most important point I think I would wish to offer is that let's not make what is good an enemy of what is the best. The best is not an enemy of the good. It is far more important to consistently be good rather than trying to be the best at all points of time, because the best, as we know, keeps changing every few months.
Absolutely.
The best is usually defined as the one that has given the maximum returns, and nobody is at the top of that chart consistently. So it is always better to choose 3 or 4 or 5 good investment products that are measurably different from one another and stick to them with discipline. If done over a period of time, I think this gives a far greater return than trying to always stay invested in the best investment product. These are the things that I would suggest to any investor who is wishing to invest.
Brilliant, brilliant. What about you, Bhavin? Any concluding remarks from your side, for the investors out there?
Yeah, so I think Jyoti mentions, invest in a staggered manner. I completely agree with that. I think this is a time to not stop investing, but maybe, stagger it out over next several months or a year. So plan it out that way, and I think that's the advice that we are giving to anybody who is, coming to invest with us right now. And and we can also do that for them, by the way. And I think but while you do that, and let's say there is a sharp correction, I would, suggest don't panic and sell, but instead, if you have kept some money on aside, try to basically deploy it more aggressively in that situation, because then you will actually benefit from having taken the staggered approach. But I think, yes, the Indian, based on whatever we know today, and barring a situation where we get a very market unfriendly government for some reason, I think we are looking ahead to a very, very strong scenario for Indian equities.
Brilliant, brilliant. Thank you so much, to all three of you for taking out time on a Saturday afternoon and sharing some deep insights about the investing. I'm sure the audience out there would have loved this session. Over to you, Aishwarya.